Brace yourselves, America, because the winds of financial calamity are howling once again. Just when you thought the lessons of the 2008 subprime mortgage crisis have been learned, a new storm is gathering on the horizon. This time, the eye of the hurricane is centered on the commercial real estate market, where 5 banks have amassed a staggering $500 billion in loans. Leading the charge is none other than JPMorgan Chase, a name that's become synonymous with too big to fail. But as the clouds darken and the warning signs grow ever more ominous, the question on everyone's mind is, have we learned nothing from the past? In the special report, we'll peel back the layers of hubris and willful blindness that threaten to plunge our nation into yet another financial abyss. So stay tuned, because you don't want to miss my final thought. Now, I'll ask you this. Are you worried about the stability of our financial system? Well, just like the banks holding risky commercial real estate loans, you need a solid foundation for your financial future. That is where Noble Gold Investments comes in. They are the experts in helping you diversify your portfolio with precious metals. Imagine the peace of mind that comes with knowing your wealth is secured by the timeless value of gold and silver. Don't let your financial house come crumbling down like a defaulted commercial loan. Act now, and Noble Gold Investments will give you a free quarter-ounce British gold standard coin for qualifying accounts. Visit nextnewsgold.com or simply call the number on the screen, 877-646-5347. Noble Gold Investments, your fortress in uncertain times. You'll find the link by tapping more below. Now, the stage is set for a financial horror show that could make the 2008 subprime mortgage crisis look like a mere dress rehearsal. American Banker has released a report revealing that 5 banks in the U.S. are sitting on a combined $500 billion in commercial real estate loans. And who tops the list? None other than JPMorgan Chase, the behemoth that seems to have an insatiable appetite for risk. Take a look.
It's coming out this month about the risks of commercial real estate loans on bank balance sheets. The report indicating that if interest rates do remain elevated and property values do not recover, default rates could reach levels comparable or even surpassing those seen during the Great Recession. For more on the commercial real estate cliff, we're talking to one of the authors of that paper, Erica Jung, who is USC Marshall School of Business Assistant Professor of Finance and Business Economics. Erica, thank you so much for joining us. This paper caught my eye. This has been a big topic of discussion, whether CRE on bank balance sheets was going to be a problem. What are the key things that you were watching? What is the situation as it stands here in terms of the status of commercial real estate?
Great. Thank you so much for having me. There are several reasons why CRE has been viewed as having an elevated stress risk. On the one hand, the commercial real estate faces increased business risk that decreases the fundamental values of properties. For example, the office properties are under significant pressure due to remote and hybrid work patterns, and the lower demand for offices can also negatively impact the demand for other commercial real estate properties like urban retail, multifamily, and also hotels. And on the other hand, rising interest rates make it very difficult to refinance CRE loans, which increases the financial risk of CRE. And most of the commercial real estate loans are going to mature in the next few years, and declining property valuation and rising interest rates make it very difficult to roll over the debt, which could lead to maturity default, which is the focus of the first part of the paper you saw.
Erica, first of all, go Trojans. But second, I do want to talk to you about that debt rollover, because I'm curious,
Yeah.
and you talk about 15% of CRE loans underwater, 45% of those are office loans. Are those loans coming due going to be the catalyst that bursts the CRE bubble?
Yes, so if we look at all of those CRE loans, and if we measure the potential default risk using 2 important measures of the stress risk, loan-to-value ratio and debt service coverage ratio, they don't look very good. I can give you some numbers if you are interested in the specific numbers.
Sure, give us some numbers, Erica.
Yeah, so the loan-to-value ratio, or LTV, can tell us whether a loan is underwater, right? So in other words, whether the market value of the property is lower than the outstanding loan amount, and we know that an underwater loan is very difficult to refinance and faces high default risk.
As the video illustrates, the commercial real estate market is a ticking time bomb waiting to explode. Delinquency rates are rising, and the value of these properties is plummeting faster than a lead balloon. It's a stark reminder of the subprime mortgage crisis that brought the global economy to its knees just 15 years ago. But here's the kicker. JPMorgan Chase isn't just exposed to the commercial real estate market. They're also sitting on a jaw-dropping $49 trillion in derivatives. That's right, trillion with a T. It's a number so mind-bogglingly large, it's hard to even comprehend. So what does this mean for the average American? Well, if you thought the bailouts of 2008 were bad, you haven't seen anything yet. Because if these commercial real estate loans start defaulting en masse, it could trigger a chain reaction that would make the Great Depression look like a Sunday picnic. But surely the banks must have learned their lesson, right? Right from the last crisis? Well, wrong. The same arrogance and willful blindness that led to the subprime mortgage meltdown are on full display once again. Banks are underwriting these loans with the same reckless abandon as before, assuming that the good times will keep rolling forever. And don't think for a second that the Federal Reserve will come to the rescue. Sure, they've got a $500 billion bailout plan waiting in the wings, but that's like trying to put out a raging wildfire with a squirt gun. The fact is, the Fed is in on the game too. They're the ones who've been keeping interest rates artificially low for years, encouraging this orgy of speculative lending. Now, it's a classic case of moral hazard. The banks know that they can take absurd amounts of risks because the government will always be there to bail them out. And why wouldn't they? After all, it's not their money on the line, it's yours and mine, the hardworking taxpayers who will be left holding the bag when this house of cards comes tumbling down. But the real tragedy is that it didn't have to be this way. After the last crisis, there were calls for real reform, for breaking up the big banks and putting an end to the too big to fail mentality. But instead, we got a bunch of toothless regulations and a slap on the wrist for the bankers who nearly destroyed the gloomy global economy. And now here we are again, staring down the barrel of another financial catastrophe. The warning signs are flashing red, but nobody seems to be paying attention. The mainstream media is too busy chasing the latest political scandal or celebrity gossip to bother with anything as mundane as the impending collapse of the commercial real estate market. But mark my words, this is a story that will affect every single one of us. When the defaults start piling up and the banks start falling like dominoes, it won't just be the fat cats on Wall Street who feel the pain. It will be the small business owners who can't get a loan to keep their doors open. It will be the retirees who watch their savings, life savings, evaporate overnight. It'll be the working class families who lose their homes and their livelihoods. So what can we do about it? Well, for starters, we need to demand real accountability from our elected officials. We need to break up the big banks and put an end to the era of the too big to fail bank. We need to reinstate the Glass-Steagall Act and create a firewall between commercial banking and the casino of Wall Street. But more than that, we need to fundamentally rethink our entire financial system. We need to create an economy that works for everyone, not just the wealthy elite. We need to invest in the real economy, the infrastructure, in education, in the things that actually create value and improve people's lives. Because if we don't, if we continue down this path of reckless greed and short-sighted speculation, then we're doomed to repeat the mistakes of the past. And this time the consequences could be even more devastating. If you got value from this report, tap subscribe. It's time for my final thought. The impending collapse of the commercial real estate market is a reminder of the fragility of our financial system. It's a system that rewards recklessness and punishes responsibility. A system that privatizes gains and socializes losses. And it's a system that is long overdue for a reckoning. But the uncomfortable truth is that we are all complicit in this system. We have allowed ourselves to be seduced by the siren song of easy money and endless growth, even as the foundations of our economy rot away beneath us. It's time for us to wake up and demand real change. It's time for us to put people over profits and build an economy that works for everyone, not just the privileged few. Because if we don't, if we continue to ignore the warning signs and pretend that everything is fine, then we are doomed to suffer the consequences of our own hubris and willful blindness. Congratulations, you made it to the end of the video. Now keep up your quest for truth with this next news report. And if you found our channel enlightening, join the millions who agree with you. Tap subscribe. Thank you for watching the Next News Network.